You should not put all your investment money in the stock market this year. Even if you do not watch through the rest of this video, at least take that point away from me today. But if you are here to really pick up on some important market insight, do stick around till the end, as I will share how I would personally invest £5,000 in 2023. Look, 2021 was an amazing year. A lot of people made a lot of money investing in the stock market. But then 2022 happened, and a lot of people actually lost a lot of this money that they gained over their previous year. If you think there's a pattern here, well, you'd be wrong, because 2023 won't be one of those amazing years like 2021. So keeping that in mind, here are 5 things I would do with £5,000 to begin with. 1, I would diversify a lot. In other words, I won't put the whole £5,000 just into a single fund like the S&P 500. In fact, I would actually diversify out of S&P 500 into other regions and other asset classes. But yes, I will start with the stock market and put most of the money in the stock market, because over the long term, that's where you get the best relative value or relative return from your money. Now, going back to S&P 500, the reason why I will diversify out of it, I'm not saying I will completely not invest in it, but I will reduce my exposure to S&P 500. And the main reason behind that is valuations. It's true that S&P 500 has gone down quite a bit last year, but if you look at valuation, it has not fallen down low enough. And when it comes to valuations, I mainly look at forward PE ratio. The PE ratio generally tells me how much money am I paying for a unit of earnings that is made by a single company or a single index. So a forward PE ratio would tell you how much money you'd be paying right now if you were to invest in a single stock or a single index like the S&P 500 based on the expected amount of earnings of S&P 500 12 months ahead. So higher the number, the more expensive it is, and lower the number, cheaper it is. Number 2, when it comes to picking or diversifying within the stock market, I will focus on dividends or income rather than capital appreciation. I would take 60% of that money from £5,000 and invest them across UK, US, Asia and emerging market index. But when it comes to picking the actual index, I will make sure that it is tilted towards or focused on dividends or high quality companies. By high quality companies, I'm talking about a very stable level of profit margins of these companies, so that even during the whole boom and bust, they were able to maintain a certain threshold in their profit margin because they had this big pricing power or a very big advantage within that market to pass on rising costs to their customers. To simplify, there are 2 main reasons why I will focus on dividends and quality. Number 1 is all to do with high level of interest rates. As interest rates are continuing to go up and is expected to go up a little bit more this year or even stay higher for a little bit longer, a lot of the tech or growth companies will continue to suffer. And the second reason is to do with inflation. Again, the level of inflation is expected to stay higher for rest of 2023. This means it is not just going to be higher cost of living for you as a consumer, it will also eat into different companies' profit margin, because high inflation leads to higher level of cost for these companies. But as I just mentioned, if you invest in companies with a very strong market power, like very strong pricing power, they will be able to pass on those increase in cost to their consumer, unfortunately. But what that will do is that it will maintain their profit level or profit margin, and that will be looked at positively by the market and the analyst, and so their stock prices should not take a big hit compared to the other companies where the profit level or the revenue level is not as strong. And finally, the reason why I will focus on companies or a market with good level of dividend yield is all to do with the total return we would actually end up getting by investing in these companies. Because remember, the total return you get from a stock or an index is equal to the dividend yield and the capital gains. So as long as dividends are there and you have a stable level of dividend in your investment, then that can actually cushion you when the stock prices go down due to various reasons such as high interest rate or higher inflation. Number 3, I will take about 30% of the investment portfolio or my money and put them into high quality corporate bond funds and US government bond fund. I have a separate video on why 2023 is a prime time to invest in bonds. So do check that out later after this video. But in this video, I will not go into the details of why it's a good time to invest in bond, but just to put it simply, it's mainly to do with the negative inverse correlation between bond prices and interest rates. So think about it, when the level of interest rates stops going up sometime this year, hopefully, then that means the prices of bonds or this bond fund performance should also start to pick up. So if you can lock in your money at a time when interest rate is actually at peak or at its highest, then all else equal, you've got yourself a sweet deal in this bond fund. Investing in a bond fund with a 4% or higher level of interest rate or income is really something to contemplate, right? When you're comparing against a volatile equity market where returns could be very low or even negative. However, what I will say is that when it comes to choosing a bond fund, make sure to focus on the higher quality bonds, which are called investment grade, and not the lower quality or junk bonds, which are generally known as high yields. And that is all to do with where we are in the business cycle, because even investing in bonds comes with their own share of risk, and one of the key being default risk, so the company is not being able to pay you the money or the interest that they promised to. So as interest rates go up this year, it will increase a lot of interest paying burden for a lot of these companies, especially the low quality companies. And that means they may not be able to pay the promised or contractual payment. In other words, they would default, and that will lead to a sell-off in that part of the market. So that would be a risk that will likely to pick up sometimes this year. So it's better to kind of avoid the lower quality or junk bonds when it comes to investing your money in a safer way within the bond fund. Number 4, if you have been keeping up with bit of mental maths, you would realize that I have about 10% left of my £5,000 portfolio to invest in. And to be honest, I will put that 10% in a high fixed interest account or a high interest savings account. And the reason being is very simple. With interest rates going up, some of these savings account or fixed interest account starting to look a little bit more promising or exciting. And this is actually one of the most safest way to put your money or lock your money in, because these accounts are actually offering you guaranteeing you a certain X% return per year for however many years you're locking your money in. And because some of these accounts are short term, so you can fix the money for a year or 2 year, 3 year, and they could have an easy access for you as well. So if you really needed that money back, you could easily get that money back from this account rather than relying on the stock market and having to sell when the market is down. And finally, number 5, with all of these investments, I will put them into the market little bit at a time rather than putting all my money into these investments all at the same time. And that is called the dollar cost average strategy, which I will employ. And the main reason behind that is all to do with volatility. When the volatility is high, that means the price swings is very high, is going up and down quite a bit. It's much better to employ this strategy rather than putting your money all at the same time. The outlook for this year is that the volatility will likely stay on for most of 2023. And again, that's all to do with the slowing down in economic activity. So a lot of countries are going to be going into recession, like UK is already there, I think. And inflation, whether it's coming down or not, enough or not, and the interest rate. Central banks will look at this inflation number, will look at what's happening to the labor market, the unemployment rate, and decide on how much more to hike and whether to pause. So all these uncertainties will lead to more price movement, both in the stock and the bond market. So that means it's better to invest a little bit every month to average out those price movement rather than locking in your money, say right now, and then suddenly the price goes down in 6 months time, and then you don't have a lot of money left to invest into the market and you're missing out on that. So yeah, that's how I would personally invest in 2023. Do let me know in the comment section below if you would do anything differently. But until next time, do look after yourself. Thank you.